If you're 65 or older and you haven't checked your bank statement carefully this year, you could be missing out on hundreds of dollars that are already yours. Right now, thousands of Canadian seniors are seeing an extra $412 show up in their pockets in 2026 due, and most of them have no idea why. Some think it's a mistake. Some think the bank made an error and quietly wait for someone to take it back. It's not a mistake and nobody's coming to take it back. It's a combination of quiet CRA and Service Canada adjustments that most people never hear about because nobody sends you a letter that says, hey, you qualify for more. That's the part that frustrates me the most about how this system works. These programs exist, the money is real, but the government doesn't call you up and walk you through it. You have to know where to look, and if you don't, you simply don't get it. That's not fair, but it's the reality, so let's fix that right now. By the end of this video, you're going to know exactly which adjustments are stacking up in 2026, whether you qualify, and the exact steps are with the exact forms to make sure you're not one of the seniors leaving this money on the table. And stick around because point number 3 is the one almost nobody claims, even though it's sitting right there on their tax return every single year, waiting for them to check the right box. Let's get into it. What is it? Every July, 2 separate things happen to your old age security and guaranteed income supplement at the same time, and almost nobody realizes it's 2 things, not 1. First, there's the regular quarterly cost of living adjustment. In 2026, that bump was 1.2% based on the change in the Consumer Price Index. This happens automatically for everyone receiving OAS or GIS, no application needed. Second, and this is the part that catches people off guard, Service Canada retests your entire GIS eligibility every July using your most recently filed tax return. In 2026, that means your 2025 tax return replaced your 2024 return as the basis for your GIS calculation. If your income went down in 2025 compared to 2024, say you stopped a part-time job, you took a smaller RRIF withdrawal than the year before, or your investment income dropped, your GIS doesn't just go up by the standard 1.2%, it can jump by a lot more because you've now moved into a different income bracket for the purposes of the supplement. What is it worth? For a single senior with no other income, the maximum GIS on top of OAS now sits at just over $1,123 a month. If your income dropped meaningfully in 2025, you could see your GIS rise by $50, $100, sometimes more per month than it was the year before. Not because of the 1.2% indexation, but because you genuinely qualify for more supplement now. Stack that annual increase with your OAS indexation bump and the age-related credit adjustment we'll cover in a minute, and that's where a meaningful chunk of that $412 annual increase comes from for a lot of seniors watching this. Let me give you a quick example, so this isn't abstract. Picture a 70-year-old widow in Hamilton. In 2024, she was still doing some part-time bookkeeping work, bringing in about $4,000 a year on top of her CPP and OAS. In 2025, she stopped that work entirely. When Service Canada ran her July 2026 recalculation using her 2025 return, her GIS went up by more than the standard indexation amount because her total income for the year was lower. On top of that, her OAS rose with the 1.2% adjustment. Combined, her annual increase landed right around that $400 mark. That's not a special program. That's just 2 mechanisms working together the way they're designed to. How do they get it? You don't apply for this one directly. It happens automatically when Service Canada processes your tax return. But here's the catch, and it's an important one. If you didn't file your 2025 taxes, even if you had 0 income, Service Canada cannot run this recalculation at all. Worse, your GIS can actually be suspended starting in July if there's no current tax return on file, because the system has no updated income figure to work from. So step 1 right now, pause this video if you need to and check, did you file your 2025 tax return? If not, do it immediately, even with 0 income, to protect your GIS from being paused. Now, I know what some of you are thinking. If my income didn't change, does this still apply to me? Fair question. If your income stayed flat or went up in 2025, you'll still get the 1.2% indexation increase automatically. That part happens to every single person on OAS and GIS, no exceptions. The bigger jump only applies if your 2025 income was lower than your 2024 income. So this isn't a guaranteed $412 for every senior watching. It's a combination of things that apply differently depending on your specific situation, and that's exactly why we're walking through all of them one at a time so you can figure out which pieces actually apply to you. What is it? This is a federal non-refundable tax credit that every senior 65 or older is entitled to claim on their tax return reported on line 30100. It's called the age amount. And it exists specifically because CRA recognizes that seniors often have lower earning capacity than working-age Canadians. Like most federal credits, this amount is indexed to inflation every year, which means the maximum value creeps up slightly each tax season. That indexed increase for the 2026 tax year is part of what's putting a little more money back in seniors' pockets when they file. What is it worth? The age amount reduces the tax you owe, and depending on your income level, it can be worth several $100s in combined federal and provincial tax savings. But here's the part almost nobody knows. This credit shrinks as your net income rises past a certain threshold, and it disappears completely once your income climbs high enough. If you're a lower or modest income senior, you're very likely getting the full credit. But a surprising number of seniors don't realize this credit even exists, especially if they've used the same tax software for years, and it's just been auto-calculated in the background without anyone ever explaining what it actually represents on their return. How do they get it? If you use tax software or a paid tax preparer, this is usually claimed automatically as long as your birth date is correctly entered, showing you turned 65 by December 31st of the relevant tax year. But if you're filing on paper, or if a preparer made an error in a past year, check line 30100 on your most recent notice of assessment. If it's blank or lower than you'd expect given your income level, that's a red flag worth chasing down. You can request a reassessment through CRA My Account or by calling CRA directly. And here's something a lot of seniors don't know. If you were eligible for this credit in past years and it was never claimed, CRA allows you to request adjustments going back up to 10 years using Form T1-ADJ. That means a missed credit from years ago isn't necessarily gone for good. I can already hear some of you asking, if this credit has existed for years, why didn't my accountant tell me? Honestly, most tax preparers are good at plugging numbers into software efficiently, but a lot of seniors are working with preparers doing high-volume, low-cost returns during tax season, and these smaller nuances, like whether you're getting the full age amount or a reduced amount because of your income level, don't always get explained out loud. It's usually not malicious, it's volume. That's exactly why it's on you, or on someone you trust, to check your own notice of assessment every single year, line by line if you have to. Visual cue, transition graphic. Point number 3, pension income splitting. Point number 3, pension income splitting, Form T1032. What is it? And this is the one I told you about at the beginning, the one almost nobody claims even though it's available to them every single year. If you're receiving eligible pension income like a company pension, a RRIF, or certain annuity payments, and you have a spouse or common law partner, Canada allows you to split up to 50% of that eligible pension income with your partner for tax purposes. This is done using Form T1032, filed alongside your regular tax return. What is it worth? Here's why this matters so much. If one spouse is in a higher tax bracket and the other is in a lower one, splitting the pension income shifts some of that income onto the lower income spouse's return, which can significantly reduce your combined household tax bill. For some couples, this results in hundreds of dollars in tax savings every single year. And there's a second benefit that's just as important. Because pension splitting can lower your individual net income, it can also help you avoid or reduce exposure to the OAS clawback. And it can help protect your GIS eligibility since GIS is based on individual income, not combined household income. So this one form can affect 3 different things at once: your tax bill, your OAS clawback exposure, and your GIS amount. How do they get it? Both spouses need to agree to the split and both need to sign Form T1032 when filing. Most tax software will actually run the numbers both ways automatically and tell you the optimal split percentage, but only if you know to look for it and select that option. If you've been filing separately for years without ever using this election, you may have been overpaying tax without realizing it. Talk to whoever prepares your taxes and ask them directly, are we optimizing our pension income split? Don't assume it's already been done. Ask every year, because the optimal split percentage can change as your incomes change. Now, some of you might be wondering, will this affect my GIS negatively if my spouse's income goes up because of the split? It's a fair concern, and the honest answer is, it depends on your specific numbers, which is exactly why good tax software runs both scenarios before you file I. It's designed to find the combination that helps your household the most, not the least. This isn't a one-size-fits-all trick. It's a calculation that needs to be run fresh for your specific income levels every year, because your numbers and your spouse's numbers can shift from year to year. What is it? This is the credit that gets overshadowed by everything else, but it deserves its own spotlight, especially for seniors managing ongoing health costs. The medical expense tax credit lets you claim eligible medical expenses that exceed a certain percentage of your net income or a fixed dollar threshold, whichever is lower. This includes things a lot of seniors don't think to track: prescription costs, dental work, hearing aids, mobility aids, glasses, and even certain home renovations made for medical accessibility reasons that don't already qualify under the home accessibility tax credit. What is it worth? Because this credit is based on a percentage of your net income, lower income seniors often see a bigger benefit relative to their total expenses, since the threshold they need to clear is lower. For a lot of seniors with ongoing prescription costs or dental work in a given year, this credit alone can be worth a meaningful amount back at tax time. And it's one of the most commonly underclaimed credits simply because people don't keep their receipts organized throughout the year. How do they get it? Keep every receipt, pharmacy printouts, dental invoices, paid amounts for hearing aids or mobility equipment. At tax time, you or your preparer total these up on line 33099 and compare it against your threshold. Most pharmacies can print you a full annual summary if you ask, which saves you from digging through a shoebox of receipts every spring. If you're claiming for a spouse or dependent as well, expenses can sometimes be pooled onto the lower income spouse's return for a better result, similar in spirit to the pension splitting we just covered. Some of you are probably thinking, this sounds like a lot of paperwork for a small credit. I get it. But here's the thing. You're not doing this instead of your life. You're doing it for 15 minutes twice a year to make sure money you're entitled to actually ends up in your account instead of the government's. That's not paperwork for its own sake. That's just good bookkeeping for your own household. So let's bring this all together. 4 things are stacking up for a lot of seniors in 2026. The July indexation increase combined with your GIS annual recalculation, the age amount credit on line 30100, pension income splitting through Form T1032, and the medical expense tax credit on line 33099. None of these are secrets, exactly, but none of them come with a personal phone call from CRA either. It's on you or on someone you trust to check whether all 4 are actually being applied to your situation. Here's your action step for today. Pull out your most recent notice of assessment. Check line 30100 for the age amount. Confirm your 2025 taxes were filed so your GIS recalculation went through properly. If you have a spouse or partner with pension income, ask directly whether Form T1032 was used to optimize your split. And start a simple folder, physical or digital, for your medical receipts this year so you're not scrambling next spring. 4 checks, maybe 30 minutes total. And for a lot of households watching this, that adds up to real money you're either already getting or should be getting. If this helped clear things up, do me a favor and share it with a friend, a neighbor, or a family member who's also on a fixed income, because chances are they haven't heard about this either, and CRA definitely isn't going to be the one to tell them. Drop a comment below and let me know which of these 4 you're going to check first, or if you've already been claiming all of them. And if you want to stay ahead of these updates as they continue rolling out through the rest of 2026, hit subscribe and turn on notifications because there's more coming, and I don't want you to miss the next one. Take care of yourselves, and I'll see you in the next video.